Hi, everyone, and welcome. We hope you're having a great day so far, and we want to thank you for joining us for our webinar on the foundations of financial stability. My name is Nancy Patton. I will be your moderator behind the scenes today. Before we dive into our presentation, I just have a few housekeeping notes that I'd like to cover. First, everyone on the line has been muted to limit disruptions. If you have questions, you're welcome to share them with us using that questions feature in your GoToWebinar control panel. A member of our financial advisory team will follow up with you after the webinar on your question. You can expect an email tomorrow with links to the recording of this webinar along with a copy of the slide deck. And finally, upon leaving the webinar, you'll be prompted to complete a very short survey. We'd like to hear your feedback and any other topics you would like us to cover in the future. Today, we are joined by Associate Financial Advisor Pierce Broscious, who is a certified financial planner, and Associate Financial Advisor Sarah Horne. Together, they are responsible for the research and development of investment proposals, portfolio rebalancing, and construction of financial plans for the Saltmarsh Financial Advisors. At this time, I'm going to pass it right over to Pierce to get us started.
Thank you, Nancy, and hello, everyone, and thank you again for joining us. We're excited to welcome you into our webinar focusing on the foundations of financial stability. I'm Pierce Broscious, Certified Financial Planner Practitioner and Associate Financial Advisor at Saltmarsh.
And I'm Sarah Horne. I'm also an Associate Financial Advisor on our team at Saltmarsh. We work with individuals and families to manage their wealth and provide peace of mind using our detailed financial planning process. And while our typical client has about $500,000 or more invested with us, these are affluent people, and they were just like you once and had to start out with the financial basics that lead to success. Most people weren't taught these skills in school and might not have learned it from their families, so we love having the opportunity to share these skills with people. National Savings Day falls on October 12th this year, and we have some great tips to help you get started on your financial adulting journey. Today's presentation is meant to give you a high-level overview of your initial objectives in your financial life and provide clarity for what you should focus on. And we hope you leave this presentation today eager to learn more.
Absolutely. So let's get started by identifying our financial goals. So when you hear the words financial goals, what comes to mind? Perhaps you're thinking about big goals like buying a home or paying off student loans. While it's important to have those big goals, it's more important to have a solid foundation and plan for achieving them. The visual you see here is a pyramid of financial goals. Obviously, you don't build a pyramid from the top down. A strong structure begins with a solid foundation. So that's why today we'll spend time talking about the foundations to financial stability, which include your insurance coverages, managing your monthly cash flow, and having an estate plan. We'll also briefly touch on a few other components of the pyramid as well. So Sarah, what's on the agenda for today?
Yeah, thanks, Pierce. So just to put things a little bit more generally, the ideas we'll cover today are managing your money, managing life event risk, estate planning, and investing.
All right, so we'll start with everyone's favorite thing, budgeting. So you may be thinking, do I have to? And of course, the answer is it depends. Those with wider margins may feel more secure about their monthly cash flow and may not need a budget. On the other hand, individuals with tighter margins who would like a more detailed look at their spending and saving habits will likely benefit most from budgeting. Think of budgets like a financial x-ray. They help examine your spending patterns and find where the pain points might be. And perhaps there are no pain points. Either way, the goal of budgeting is to create a positive net discretionary cash flow. That means that you're spending less than you earn each month. And there's money left over after all expenses are paid. This is money that you can use to save, invest, or put towards a certain goal. On the other hand, if you're spending more than you earn each month, it may be time to create and review a budget to see if there's any surprises or areas that you could trim your spending. Remember, the only way to address a shortfall of money is to either make more or spend less. There are many budgeting resources available online. If you like using a template or worksheet, Saltmarsh has a great one that's very comprehensive. You can visit our website at saltmarshfa.com and submit an inquiry there if you want a copy. If you like using an app, Mint is a great option. Or if you prefer building your own budget, Excel is always your friend. So now that we've covered budgeting, let's talk about the importance of saving.
Yeah, thanks, Pierce. So saving money is something that's really important to get started as, a financially independent adult. But your feelings about saving money can depend on how you were raised. And as for me, my dad passed away, and it was during the height of the financial crisis in 2007 and 2008. And so my mom had to step up and be the main breadwinner for my family. And I was a young teenager at this time, but I saw her really being discerning about her spending so that way she could save money. And when an emergency came up, we had enough money to cover it, and that was, something we were really blessed by. We call that having an emergency fund, and that's one reason you should start saving. Over time, you should accumulate and maintain about 3 to 6 months worth of necessary expenses, which, thanks to Pierce talking about budgeting, you should know how much that would cost every month. And after you have that amount saved, you can focus on more tangible goals. Maybe you're interested in saving for a down payment for a home or a car, or even take a fun vacation. It's really up to you, and you might even take it a step further and automate your savings. You can schedule automatic recurring transfers from your checking account to your savings account, or even use your company's direct deposit function to put a portion of your paycheck into your savings every month. And because I know talking about financial discipline isn't the most exciting thing you can do, I'd love to give you a fun fact about piggy banks like you see on the screen. Piggy banks first began back in the Middle Ages when people would use pots made out of this material called pig. That's spelled P-Y-G-G. They would put their money in those pots. So over time, that kind of evolved into the shape of the animal pig, and we use those today to start saving as children.
Yeah, that's very interesting, Sarah. I always wondered why they used that animal and not another animal. So now let's get into talking about managing debt. And debt is one of those topics that usually gets a bad rap, but it actually isn't always a bad thing. And even in certain cases, it can actually be beneficial. For example, if you're beginning to establish credit, having a reasonable amount of debt that you can afford to pay off each month could actually improve your credit score. So when it comes to knowing good debt versus bad debt, you can use a few factors to help guide your decision. The first is, what will the debt be used for? Will it be used to purchase a car? That's useful. Cars usually last 5 years or more. Is it to fund a vacation? Maybe that's not the best use. Vacations only last about a week or so, but the debt that you use to fund that vacation, you could be paying off for a few years or more. Another factor is, what's the interest rate? Home and car loans will typically have very reasonable rates since they can be secured by the home or car. Credit cards will generally have the highest rates since they're unsecured. And oftentimes those rates can get up to 20% or greater. This is why, as a general rule, carrying a credit card balance from month to month is always bad debt. You may ask, how much debt is reasonable? Well, let's imagine that you're going on a hike. How much weight could you manage in your backpack? Of course, you would want to carry the necessities like food, water, and bear spray. Just ask Sarah, she loves hiking. But you wouldn't want to add too many other items to weigh you down. Debt is the same way. Carrying too much debt with you throughout your life impacts your ability to make progress towards your saving goals. On the other hand, you'll want to carry some debt that will allow you to purchase useful things, which may require a large lump sum payment. When it comes to paying off your debt, pay the full balance due each month if you can. If you can't, budget in an amount that you can afford to begin making progress.
Yeah, that's awesome, Pierce. Of course, I love any analogies related to hiking. That's one of the things I enjoy doing a lot. So thanks for covering that, Pierce. Now let's talk about how we can use insurance products to limit our exposure to financial losses. So life is just filled with risk. It just kind of comes with the territory. But today I'm talking about financial risk. And that means if a certain event were to happen, it could cause significant financial harm to your family. And there are three main ways of handling debt. You can either cover it yourself, like we talked about with your emergency fund. You could try to just avoid the risk altogether, or you can transfer the risk to another party. Insurance is a way that you can transfer your risk to a company in exchange for premium payments. And we'll talk about different types of insurance in this slide. So first, we'll talk about health insurance. This is probably really familiar to you. The risk that you're insuring with health insurance is medical bills that you could incur just by visiting the doctor or even having a larger procedure done. Life insurance is a little bit different from health insurance, and it pays a benefit in cash after a person passes away. And this is really useful if you have people who are depending on your income, or if you might leave behind debt if you were to pass away prematurely. And in fact, life insurance was a really valuable thing to my family when my dad passed away. Like I said, he was the main breadwinner, and the life insurance money that we received actually helped pay for my brothers in my college. So that's another use you can use your life insurance for. Disability insurance insures over the risk that you might lose income because of a disability. So just for an example, let's say you're a surgeon and you break your hand in some type of accident, which would make it difficult to perform surgery and probably impossible. So you would potentially lose income for not being able to perform your job. But if you have disability insurance, that would provide some backup money that you could use to cover your expenses and replace a part of your income. Home and auto insurance is probably also pretty familiar to you, and it covers damage to your home or car. And umbrella insurance is a little bit different, and it can only be purchased if you have home and or auto coverage. And essentially, it's just additional liability protection for high ticket costs and events that would exceed the coverage that's provided by your home and auto insurance, and can be a really cheap way to add additional protection to your insurance plan. Finally, long-term care insurance is most commonly used by people in their old age if they need to enter a long-term care facility or receive long-term care to extend their quality of life and give them, more comfort as they age. It can be really expensive to receive this care, so long-term care insurance helps cover the medical expenses and the facility expenses that are associated with these types of events. And while this isn't a comprehensive list, I certainly recommend working with a reputable and trustworthy insurance agent who can shop policies with mutual or multiple companies to help find the best coverage for your needs. And I actually have a little bit of a background in insurance, so if you have any questions for our team, we'd be happy to point you in the right direction and help you avoid any insurance pitfalls.
Yeah, absolutely. So now that we've talked about covering risks during your life, let's talk about planning for the future with estate planning. So estate planning, and why is it important? Well, unless you've been told otherwise, you don't know when you're going to die. And if you have property, or as we call it in the industry, the technical term is stuff, you need to designate who gets your stuff when you die. This is what an estate plan is for. An easy way to do this is to designate beneficiaries on your retirement and or investment accounts. However, in most cases, this isn't enough. In addition, a proper estate plan includes documents that are meant to speak for you when you're unable to speak for yourself. So what are these things in an estate plan? Well, there's many different documents, but at a basic level, there's a few things that we think most everyone should have. These documents are drafted by a licensed estate planning attorney, and if you're interested in learning more, we'd be glad to point you in the right direction. The first document is a will. This contains legally binding instructions for who gets your stuff when you pass. This one's very important because if you die without a will, guess who gets to decide instead? The state government. Having a valid will in place prevents this from happening. The next document is a power of attorney. This appoints a designated individual to act on your behalf. There's different kinds for different situations. However, a durable power of attorney appoints an individual to speak for you in the case that you are incapacitated and unable to make decisions for yourself. That may be the most important situation, so having that in place or having someone that you can choose to be able to speak for you is very important. A healthcare directive is also called a living will, provides medical instructions with your wishes if you're in a state of no recovery. The last one is a trust, and trusts are more advanced and specific. Not everyone needs a trust, but usually they're used by individuals with a reasonable amount of wealth and allows them to specify more complex wishes than a will. There are many different types of trusts. However, the main goal of a trust is usually to provide for continuity and management of the trust assets by a trustee for a designated purpose. Trusts also avoid probate, which is the process of the court interpreting your will after you pass. So
Awesome.
now we can discuss the topic that everyone's been waiting on, investing.
Yeah, so that is kind of the bread and butter of what we do. We focus on all these areas, but we especially love to talk about investing. That's one of the more exciting parts of our job. So we certainly encourage all of you to set the foundation that we've talked about today by saving extra money every month to meet your financial goals. But you need more than a savings account for big goals like retirement. So you should match your goals with the right types of accounts to use. So we'll talk about different types of accounts in this slide. Retirement accounts are designed for retirement, making it really easy to know what those are. IRAs, you've probably heard of these. They stand for individual retirement arrangements. Fun fact, they don't stand for individual retirement accounts, but you can set up one of these accounts for yourself at a brokerage. 401ks, 403bs, and 457b plans are provided by your employer, and they're used for retirement savings as well. One thing that's really great about these accounts is that your employer will sometimes make matching contributions to the contributions that you make. So it's kind of like getting free money put towards your retirement, which nobody is going to hate. One thing that I'd like you to know about these accounts is that they have different tax benefits. So pre-tax retirement accounts allow you to put money in before you've paid the taxes on that money. But when you withdraw it in retirement, you do have to pay income tax on that money. Roth is the opposite. You pay your money or you pay your taxes when you put the money into the account, and you don't have to pay taxes when you withdraw it during retirement. One thing to also note is that there are penalties from withdrawing some of these types of accounts from before a certain age, which is 59 and a half. So you should really only invest in these types of accounts the money that you're planning to use in retirement. You wouldn't want to invest more short-term money in those types of accounts. Taxable accounts are another type of investment account that do not come with withdrawal penalties and are used for non-retirement goals. One thing that you should notice about these is that you are liable for capital gains taxes when the investments in your accounts grow and you sell them. You have to pay taxes on that growth. And if you receive any type of dividends from the investments in the account, you'll have to pay income taxes on those. So be aware that that's why these are called taxable accounts. You owe capital gains and income tax sometimes. Finally, charitable accounts, like you'll see on the pyramid or towards the top of the pyramid, these are things that you would want to focus on after you've built a solid foundation and have built up enough wealth to reach your own financial goals. These accounts are used to build wealth for future generations, maybe your kids or your grandkids, and they can include donor advised funds, charitable trusts, 529 college saving plans, and more. So now that you know about the different account types that you can use, let's talk about what goes inside them, what type of investments you can use within them to reach your financial goals.
Absolutely, Sarah. Well, what we want you to understand is there's a big difference between saving and investing. And this graph helps to illustrate the difference between the two. What you see here are the risk and return characteristics of U.S. stocks and bonds. Imagine that you were alive in 1926, and maybe you were. And imagine that you had only invested $1 in each of these asset classes back in 1926. And then last year, looked at your account balance. Saving in your bank account is represented by the light blue line labeled Treasury bills. As you see, that $1 only grew to $22, which was almost right in line with inflation. Now, keep in mind, these are long-term numbers. In 2022, inflation has outpaced savings deposit rates by a wide margin. So let's take a look at the lines above Treasury bills. These represent some of the investment options available to you. The key to choosing an investment strategy is to understand the concepts of risk and return. As you see over the long term, U.S. stocks, represented by the top two lines, achieved the most growth. That $1 investment turned into tens of thousands of dollars in the case of small cap. But they also experienced the bumpiest ride to the top. And you would have had to stay invested through some times of tremendous uncertainty along the way. Bonds, on the other hand, represented by the green line, grew to a much smaller amount. However, they saw less bumps in the road. Most investors will take an approach that includes both stocks and bonds, so they can see the growth from the stocks and the stability from the bonds play out over time. Younger investors likely need more stocks in their portfolio to help their investment help their investments grow towards retirement. Investors closer to retirement will likely need more bonds in their portfolio because they have less time to recover from any stock volatility. Although markets go up and down, long-term investors who stay committed to their strategy put themselves in the best position to be rewarded for their patience. Staying committed to your approach over many years will allow you to ride out the bumps in the road and enable you to see growth. A funny story is that we actually presented this to a client once, and they said, "Great, if I'm reading this right, we should go all in on small cap." So Sarah, let everyone know what we told them.
Yeah, I mean, he must have been smart. He knows how to read a graph, but we wouldn't always recommend just investing in one type of investment or one singular asset class, but it's a really valid question. Why wouldn't we always go all in on the thing that's performing the best? This chart helps answer that question. It shows the returns for different areas of the market from the year 2007 through 2021. It shows large companies, small companies, companies from all over the world, as well as bonds, and each of those is represented by a different color in this chart. Small cap stocks, which Pierce mentioned in the last slide, are represented by this light kind of baby blue color. So as we look at this graph, we can ask ourselves, how many times is that baby blue color number one? And only out of the last 15 years or so, it was number one only 3 times. And in fact, over this period of time, large cap was doing a little bit better than small cap. So the reason you don't want to invest in only one asset class is that you just can't assume it'll always be the best. Instead, the best way to go forward is to use all of the colors in the right combination for your risk tolerance. This practice of investing in all areas of the market is called diversification, and diversification is the best way to reduce risk because of having just one asset class or a high concentration of one in your portfolio. So let's talk about some easy ways to start investing next.
Yep. So some easy ways to begin with investing, whether you're investing in your company's retirement plan, your own investment account, or an IRA, you'll likely have different investment options available to you. We generally recommend using mutual funds or exchange-traded funds, also known as ETFs, rather than individual company stocks. These types of funds will generally include many different stocks, sometimes thousands, and or bonds in one fund. We would generally recommend using funds that are broadly diversified, as Sarah described in the previous slide, as well as low cost in nature, with a low expense ratio, and also remember to be mindful of transaction fees. Funds can have different strategies, so here are a few ideas for getting started. Let's talk about the do-it-for-me options, and these are like set it and forget it options. There are target retirement date funds and target risk funds. The target retirement date funds are managed to target a retirement year. These funds are designed for growth during your working years as you're contributing to the fund, and are managed to reduce your risk very gradually as you approach retirement. The target risk funds are managed to target a certain risk tolerance. So these maintain a static mix of stocks and bonds for the life of the fund. For example, a 60-40 fund will aim to keep 60% in stocks and 40% in bonds. An important note, if you're choosing a target risk fund, is to understand and know the range of possible return outcomes based on that level of risk. So these are the two options which perhaps could be best for people who prefer that set it and forget it approach. But what if you want a little bit more control over your investments?
Yeah, so I can talk a little bit about that. People who have maybe more investment experience or are a little bit more sophisticated in their approach, they might want to build their own investment strategy, but they should certainly use risk and return concepts as well as diversification as a guide in building that. So we would love to share a little bit more about who we are at Saltmarsh Financial Advisors. We certainly appreciate you all joining us today. So we at Saltmarsh provide personalized financial advice and investment management to individuals and families. And we like to work with people who want a long-term relationship with a fiduciary investment advisor. And we say this all the time, since every investment decision is a tax decision. Another unique value that we offer is collaboration with tax professionals, which helps us ensure that you make tax efficient, tax mindful choices. We also adhere to a pretty strong investment philosophy. First, we believe that markets are efficient, which means you can't time the market by jumping in and out of different investments. And like we talked about, we also believe risk and return are inseparable, and diversification is really critical. Finally, we believe that costs matter a lot, and so we only recommend using funds that carry low internal fees. We would love to speak with you if you or someone you know is interested in learning more. So thank you all so much for joining us today.
Thanks, everybody. Happy National Savings Day.
Thank you so much, Sarah and Pierce. That was a very quick, insightful webinar, and I'm sure people found something useful. For one, I have a lot of stuff, so maybe I should get on that estate planning. But thank you again for a great webinar. Audience, as a reminder, there will be a quick survey after this webinar. We'd love to hear your feedback and any other topics you would like our team to present on. We're open for anything. But other than that, we hope you have a great rest of your day. Thanks again for joining.
Thanks, everybody.
Thank you.